macroeconomy has a huge effect on everything I'm learning and what I'll be doing after graduation. So I really was excited to have the opportunity to see the Federal Reserve Governor Bill to speak to our university and get their first-hand advice on things.
Being that I interned at the Federal Reserve this past summer, I wanted to get the perception currently today of how the bank is holding up with the current situation.
Well, one thing that I loved was the fact that she was a drama major in college, and so the fact that you could go from a general degree in something totally unrelated to banking and now work your way up to one of the most powerful positions in the country in the banking sector is just phenomenal. And I think it shows that what you really want to get out of college is the ability to think and analyze things critically, and it doesn't matter so much what you major in. The sky's the limit.
I thought the Q&A was great. I was really impressed by the breadth of questions and the breadth of students. A real international showing of students asking a range of interesting and some very difficult questions. And I thought the governor handled them pretty well.
I really enjoyed the Q&A because some of the students clearly were prepared. They had read some of her other speeches and things, and asked her questions about housing and consumer credit and just general questions about the economy.
It was wonderful because she was able to express that the idea that different people come into the Federal Reserve with different viewpoints, with different angles, and it's those different perspectives that helps put into play what should occur in our monetary policy, in the Federal Reserve System, and how people need to interact with one another to learn what each other has to say.
I just think it's great that we can get such important and very vocal people that are changing things every day in our country to come here, and I'm so excited to have the opportunity right before I graduate to see someone like that.
It was just a nice event, and compliment the University of Richmond for putting it on, and thank them for hosting it.
Thank you very much. Tell you what, this is a beautiful auditorium. It feels more like my days as a theater major than my time as a banker. It's certainly a pleasure to be here at the University of Richmond and to take part in the Robbins Executive Speaker Series. Tonight I've been asked to share with you some of the memorable experiences and amazing opportunities that have shaped my journey from theater major to part-time drive-through teller to Federal Reserve Governor. I'll talk a bit about banking and the important role that lending plays in the economy. I'll describe how my banking career led me to a seat on the Federal Reserve Board and how that unique perspective has helped me to add value after I arrived there. I'll then explain some of the actions that have been taken by the central bank at a time of extraordinary financial uncertainty, and I'll describe some of the attributes that make the Federal Reserve an institution like no other. I'll end with a few thoughts that might resonate with the students in the audience as they conclude their studies and prepare to join the workforce. I never planned to be a banker. I wanted to be an actress. I spent my college years pursuing a degree in dramatic art. I chose a career in banking for one simple reason. I needed a job. Regardless of economic conditions, the acting profession has an unemployment rate of about 95%. So I looked for something that I could do almost anywhere and with hours that would leave plenty of time to pursue my dream. I found a job as a part-time drive-through teller. Then later, when I needed a full-time job, I went to work in a startup bank. And even though I didn't start out to be a banker, I found a career in that little bank. President of the bank was a man named Bert Harrison. Bert was an old-fashioned community banker and a natural teacher. He taught me everything he knew about banking, and that was plenty. And 15 years later, when he died suddenly of a heart attack, I had learned enough to take his place as chief executive officer. My banking education began with him as my mentor, with plenty of on-the-job training, which was later supplemented with industry schools and an MBA earned at night. Because the bank was just starting up, there were only 11 employees, with lots of work and not many people to do it, I was able to try my hand at nearly every job in the bank, and also to see the results of every action that was taken. Much of my time as a community bank was spent lending to small businesses. In many banks today, small business lending is an automated process, relies on computers to analyze data and determine a borrower's creditworthiness. For me, the process was personal. It involved sitting eyeball to eyeball across the table from my customer, More often than not, the customer was someone I knew well and had been lending to for years. Occasionally, he or she represented the second or even the third generation to run the business, or the business itself was the second or third venture that I had financed for the same borrower. There were financial statements to be gathered and analyzed. Usually it was difficult, if not impossible, to separate the business and the personal finances. But understanding the borrower's ability to successfully run a business was just as important as analyzing the numbers. I spent a lot of time talking to business owners about their businesses. In fact, sometimes I thought they came in looking for a sounding board for their ideas as much as they were looking for money. At times, especially during the economic downturn of the early 1990s, I had to deal with problem loans. Some were resolved by restructuring and some through foreclosure. So now, as a bank regulator in the middle of a financial crisis, this deep personal understanding of the lending and loan collection process has strongly influenced my policy views. And I've never lost sight of the importance of those small businesses to local communities or the importance of loan availability to small businesses. I fully expected to complete my career working as a community banker in my hometown. But in early 2007, I received a call asking if I would be interested in serving as a member of the Board of Governors of the Federal Reserve System. I was intrigued, flattered, and more than a little intimidated by the prospect. I had interacted with the Fed throughout my banking career and had even served on the board of directors of the Federal Reserve Bank of Richmond, so I knew a lot about the Federal Reserve, but there was no way that I or anyone else could have foreseen the tumultuous events that were about to unfold. The Federal Reserve is the central bank of the United States. Congress created the Federal Reserve in 1913 after a series of banking panics. According to the Federal Reserve Act, to furnish an elastic currency, to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for other purposes. When I joined the Board of Governors in August 2008, the Fed's ability to respond to financial crises was about to be tested as never before. For as long as they have existed, central banks have calmed financial crises by lending to financial institutions against good collateral. Because central banks step in when other sources of funds retreat, central banks acting in this capacity are known as lenders of last resort. But that phrase doesn't mean that central banks make bad loans. Nearly all the loans are to sound borrowers with good collateral. Banks rely on short-term funding, such as overnight interbank loans or customer deposits, to make the longer-term loans that their customers need. If funding becomes scarce, banks become less willing to extend credit. To maintain the flow of credit to businesses and consumers, the Federal Reserve provides short-term credit to sound depository institutions as needed. To ensure that banks use the facility only as a backup source of funds, Federal Reserve loans are usually made at an above-market rate. In the panic of 2008, liquidity needs were not confined to the banking system. The shadow banking system, made up of investment banks, money market funds, finance companies, and investors in a wide range of debt securities, provided a large part of the credit that fueled our economy. When panic set in, it froze lending in banks and non-banks alike and produced funding pressures across a wide range of markets and institutions. The actions taken by the Federal Reserve to fight the crisis were quite traditional in the sense that for years central banks have been providing liquidity by lending to financial intermediaries. But they were unconventional in that those concepts had to be adapted to fit markets and lenders that had never been supported by the Federal Reserve before. Now, I didn't live through the banking crisis of the distant past or those that might have occurred in other countries, but I can tell you what it was like at the center of the most recent crisis. Funding was drying up for one institution after another and one market after another. Our efforts to provide liquidity were criticized by some as bailouts for the banks. And I can understand how it could seem that way, but I also know that every action the Fed took was directed at improving the economy rather than the well-being of the banks. We had to make many difficult decisions in the darkest days of the crisis. For me, those decisions were made a little less difficult by several factors. First and foremost was the calm, decisive leadership by Chairman Bernanke, whose lifelong study of economics and economic history provided unique preparation for his own role in history. Almost as important were the hundreds of Fed economists, lawyers, bank supervisors, and market specialists who worked around the clock to craft creative solutions to every financial market challenge. I'll never know how many hours it took to develop and implement all of the programs they presented in a series of emergency board meetings. I do know that they responded to every question and strived to mitigate every risk that was identified. And while the strain was evident in their tired eyes, the collegiality and intellectual rigor that I've come to know as a hallmark of the Federal Reserve never wavered. Finally, for me, it was the image of all those small businesses that depended on credit to run their businesses. The Fed provided credit to banks large and small, and in addition to others, through programs we supported the market for securities backed by loans to households and businesses, including loans for business equipment, inventory, insurance payments, business credit cards, and loans guaranteed by the Small Business Administration. To be sure, lenders reacted to uncertain economic conditions and weaker borrowers by tightening credit standards. But with liquidity provided by the Federal Reserve, loans to borrowers who met those tighter standards continued to flow. The U.S. economy still faces challenges, but I'm convinced that the forceful actions of the Federal Reserve in 2008 helped prevent what clearly would have been a far worse scenario. The Federal Reserve was originally created to guard against financial panics, but in modern times, many people think of monetary policy making as its primary role. The Congress has given the Federal Reserve two objectives known as our dual mandate: foster maximum employment and price stability. In its conduct of monetary policy, the Fed influences the level of output and the level of prices in the economy through changes to interest rates and credit conditions. During more normal times, the Federal Reserve's policymaking is focused on short-term interest rates, which is our main tool for steering the economy. The Fed influences the cost of borrowing to purchase everything from cars to condos to computers by controlling short-term interest rates. Interest rates can be lowered to stimulate borrowing and spending when demand is otherwise weak, or raised to damp demand and curb inflation. Before I arrived in August 2008, the Federal Reserve had already responded to weakening in the economy by aggressively lowering its federal funds target from 5.25% in September 2007 to 2%. From a historical perspective, 2% is an extremely low level for interest rates. But as the financial crisis intensified and the economic outlook became more dire in the fall of 2008, the Fed continued to cut rates. For more than 3 years now, our policies have held short-term rates close to zero. Just as the Federal Reserve used traditional concepts in unconventional ways to provide liquidity to the shadow banking system and stop the panic, once our main short-term interest rate level was effectively at zero, we moved beyond traditional monetary policy, purchase longer-term assets, and push down longer-term interest rates. Those purchases put downward pressure on longer-term interest rates generally and helped normalize the spread between mortgage rates and long-term Treasury rates, which had widened during the financial crisis. Reducing longer-term rates influences the economy in much the same way as lowering the expected path of short-term rates. For instance, the decline in longer-term rates lowers the cost and increases the availability of capital and credit, which in turn encourages business expansion. In the most recent episode, another important result of lower rates has been a reduction in debt service burdens from existing debt. Households in particular have significantly reduced mortgage payments through refinancing, and when I see the small business owners that I used to lend to, they tell me that they couldn't have survived the downturn without lower rates. Monetary policy decisions are made by the Federal Open Market Committee, the FOMC. While all 12 Reserve Bank presidents and all members of the Board of Governors participate in the FOMC discussions, the voting members of the FOMC are made up of the members of the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 of the remaining presidents on a rotating basis. In normal times, monetary policy is implemented through the purchase or sale of securities, which affects the supply of bank reserves and so has an effect on short-term rates. But monetary policy also works by influencing expectations of future short-term interest rates and thereby affecting long-term rates and asset prices. Central bank communications can help individuals, businesses, and investors formulate their expectations for interest rates and inflation in the future and thus influence their actions today. Recognizing the importance of communications as a policy tool, the FOMC has been engaged in a conversation about how we might better explain our framework for decision-making. In designing its communications, the FOMC faces complexities that make clear communication more difficult than you might think. First, we need to explain the way we think about both parts of our dual mandate. Establishing a target for inflation is a tool used by many central banks to anchor inflation expectations. Central banks can establish such a target because over the longer run, inflation is determined primarily by monetary policy. By contrast, the level of employment that would be considered consistent with maximum employment is influenced by factors other than monetary policy that may vary over time. The difficulty for the Federal Reserve lies in communicating clearly about the employment portion of the mandate, without creating an impression that the committee is either establishing an unemployment target or ignoring that part of the mandate altogether. I do not believe that establishing an inflation target is inconsistent with a commitment to both parts of the dual mandate. On the contrary, it can help with thinking about and achieving both parts of our mandated objectives. For example, if having an explicit numerical target for inflation helps anchor inflation expectations over the longer run, then monetary policy will have greater flexibility to pursue the goal of maximum employment in the shorter term. The second complexity in our communication has to do with the nature of committee decision-making and the unusual voting structure of our committee. For example, when preparing for a committee meeting, I formulate my own outlook for the economy and opinions about the best path to follow. But I also rely on the committee discussion to help me decide whether or not to support the policy favored by a majority of voting members. As long as it's within a range of policies that I would view as appropriate, and I don't believe that the potential negative consequences outweigh the expected benefits, I will support the committee decision. Now consider the three different ways that I might communicate that thought process. I could make my own preferences known in a public speech such as this one, or 4 times a year, I submit my economic projections to be combined with those of all the participants at the FOMC and published as ranges in the Summary of Economic Projections, which is then used by the chairman to discuss the views of the committee in a press conference. And I have the opportunity to record a vote for or against any action taken or statement issued by the committee itself. For Reserve Bank presidents who rotate votes, communication becomes a bit more complicated when they don't have the opportunity to vote for or against a committee action. I think it's hard to know which communications channel, the individual statements of preference, ranges that include the unattributed opinions of voting and non-voting participants, or committee-approved statements, which is most helpful for members of the public in forming their own expectations of policy. So far, I've talked about what the Federal Reserve has done during the time I've been there, but I haven't really told you what the Fed is or what it's been like to be a policymaker there. The Federal Reserve is an independent entity within the federal government in that its decisions do not have to be ratified by the President or any member of the executive branch. The Congress, through the Federal Reserve Act, sets the Federal Reserve's goals and oversees it, but the Federal Reserve decides independently how to achieve its congressionally mandated goals. The ability to make monetary policy decisions that are free of short-term political influence is critical for central banks. This is especially true because the effective conduct of monetary policy requires a long-term perspective. A central bank that is subject to political pressure might opt for policies that favor rapid expansion in the near term at the expense of higher inflation in the future. Such actions would surely result in the loss of the public confidence and credibility that are needed to achieve the objectives of monetary policy. Indeed, research has shown that countries with independent central banks have better economic performance and lower inflation than countries whose central banks are not independent. The structure of the Federal Reserve is uniquely American in its decentralization. The Federal Reserve System is made up of the Board of Governors in Washington, D.C., and 12 Federal Reserve banks across the country. The members of the Board of Governors are nominated by the President and confirmed in the Senate. Each Reserve Bank has a board of directors drawn from business, public, labor, nonprofit, and banking leadership within its district. Then in consultation with the Board of Governors, the Reserve Bank directors choose a president to run the bank. The Board of Governors oversees the Reserve Banks and is responsible for formulating bank regulations, supervising banks, and making decisions regarding lending other than discount window lending to depository institutions. The 7 members of the Board of Governors serve 14-year terms, with one term ending in January of each even-numbered year. The terms run independently of the person serving in them, and members are often appointed, as I was, to fill unexpired portions of a term. As has been the case for most of my time on the board, there are currently 2 vacancies. A 3rd vacancy would be created when my term ends this month. However, the law permits me to serve until someone is appointed and confirmed for my seat. I think it's important to have a full board, in part because of the volume of work, but also because it's helpful to have a diversity of backgrounds and expertise to address the breadth and complexity of the issues that require board action. For example, with the Fed at the center of the banking system, it's useful to have someone with banking knowledge. Currently, my community banking background provides practical insight, as the Federal Reserve is highly focused on strengthening the financial system without strangling the ability of smaller banks to serve small businesses and local communities. So I'm planning to stay on for a while. But as strongly as I believe in the importance of a full board, I'm hesitant to make an open-ended commitment to stay for as long as it takes to fill the current vacancies or until someone is nominated and confirmed for my seat. That said, I'm fully engaged every day with important issues that are at the center of our economic recovery. It's gratifying to have such an opportunity and to be able to work in this unique institution. The culture of the Federal Reserve is an interesting blend of government, academia, and business. Differences of opinion regularly occur, but they are a source of strength rather than conflict within the institution. They add liveliness to the debate and richness to the decision-making process. The system is a treasure trove of data, research, and institutional memory about the economy and the financial system. It is stimulating and occasionally exhausting to be surrounded by so much brain power and intellectual curiosity. But everyone approaches the work with a serious sense of purpose and collegiality. It's difficult for me to describe what it's like to work there, but if you ever get the chance to do so, I would highly recommend it. Now I'd like to turn to my final task, to offer some career advice to those of you just preparing to enter the business world. As someone who has spent more years than I care to count in that world, let me begin where I began. I needed a job just as many of you will soon. In searching for that first job, or even some of the ones that come later, don't be afraid to take one at the entry level, as I did when I started as a teller, or one that seems quite daunting regardless of your qualifications, as I faced when I joined the Federal Reserve. Look for a career that you enjoy and one that is well suited to your temperament and your talents. Remember that what you think you want most in life might not be the thing that makes you truly happy. I could have been miserable as a mediocre actress. Instead, I happened upon a deeply rewarding profession that I loved. Indeed, I found that life usually works out for the best if you let it. Whether you found your perfect career or just a job to pay the bills, make the most of every assignment. I told you earlier about my banking mentor, Bert Harrison. Well, Bert was always loading me up with projects. Remember one day I was struggling to dig my way out from just a mountain of work. I was really in the weeds, and here came Bert with yet another assignment. I looked up, looked at him, and I said, you know what? You bring me work like you're handing out presents. He kind of walked on off, went back to his office. And after about 15 minutes, he came back over, and he was standing there, and I looked up, and he said, you know what? I think they are presents. And he was right, because those projects taught me more than any class ever could have. Finally, if as I suggest, you're going to take advantage of all the opportunities that come your way, I'd like to stress the importance of lifelong learning to develop the skills that will be needed to tackle new challenges. You might very well find yourself pursuing a direction different than the one you trained for in business school, but the lessons you learned here will still be important. You need to apply the concepts you know to situations that are different from what you expected to find. And you may need to learn new concepts. Your ability to think critically and creatively, along with your skill at tracking down the information you don't have, will be among your most valuable assets. Remember that sometimes asking the right questions is just as important as knowing the right answers. And if you get a chance to teach others, take it. Nothing solidifies your understanding of a subject like having to communicate it clearly to others. In closing, I'd like to make a shameless plug for public service. Putting your knowledge and skills to work for the good of the nation is a very high ideal. I think Woodrow Wilson, the president who signed into law the Federal Reserve Act, said it well, albeit long-windedly. You are not here merely to make a living. You are here in order to enable the world to live more amply, with greater vision, with a finer spirit of hope and achievement. You are here to enrich the world, and you impoverish yourself if you forget that errand. Aside from the obvious societal benefits, there's much to be gained personally from working to achieve the greatest good for the greatest number of people. It's been richly rewarding for me to bring decades of experience as a banker to discussions on matters that have the power to transform that very industry. And I've been fortunate to work alongside other public servants who share the commitment to bettering the lives of the people we serve by working to ensure a strong financial system and a stable economy. Thank you for inviting me to spend some time with you tonight, and I'll take some questions.
So I will monitor the questions. Over here? Did you have a hand? Oh, there we go. Right behind you. Oh, you were waving.
I was waiting.
Hi, Bob.
Right behind you, you have a question.
What is the net effect when the Federal Reserve, when the Treasury sells bonds and the Federal Reserve buys them? Is that inflationary, deflationary, or what?
The question is, what is the net effect when the Treasury sells bonds and the Federal Reserve buys them? Is that inflationary or not inflationary? Monetary policy does impact inflation, and so every action that's taken in monetary policy does. One thing I would point out is that the Federal Reserve is not permitted to buy bonds directly from the Treasury. So there are two pieces to that, and one, monetary policy actions absolutely impact inflation. The second, which you might be referring to, is something called monetizing the debt, which is basically you're issuing bonds to yourself and issuing currency to fund them. And I think that would be the case if we were expected to hold those securities over the long term, but our purchases are intended to be temporary in nature, and then we will resell the securities that we have purchased.
More questions?
Lots of people were speculating that the global financial crisis of 2008 was caused by deregulation policy of subprime loans and credit default swaps, and I was wondering if there is any future policies to be taken to re-regulate the markets that have caused the crisis.
In terms of actions taken to re-regulate or additionally regulate the markets, there are, you have the entire Dodd-Frank Act, which is directed at regulating institutions, particularly larger institutions, and their ability to take on risk. It is directed at the practices of the mortgage lending business altogether. And so I would say there have been a lot of actions taken to do that. In addition to the Dodd-Frank Act, I think certainly we learned how quickly a financial crisis can develop. And so at the Federal Reserve, we now have a number of people who are focused particularly on signs of financial stability and are monitoring markets all over the world, really, to find vulnerabilities that might threaten our financial system.
More questions? Yes.
I hate to ask another question, but what is the definition of monetizing the debt? What is the definition of monetizing the debt? I never could understand that.
It's simply if you continue to create more money simply to pay your debts, and you do that, and that would tend to drive inflation very high.
So we can pay off our debt by doing that?
Well, no, you actually can't over time, because the money ends up being worth less and less, and so it takes more and more of it to pay off the debt.
How about some students over here? Students, questions? Okay, great.
Based on your experience working in the banking sector, what suggestions or advice would you give European banks as they move forward and out of the financial crisis?
The European banks are dealing with some difficult situations in that the issue over in Europe is really that there are questions about the sovereign debt. So it would be, the same situation would be if United States institutions, we're dealing with questions about the United States debt. And so they're having some difficulty. I think the thing I would learn is, and that I would advise them, is that capital is, at the end of the day, the most important thing for a financial institution to survive any financial crisis. And so their access to the capital markets and their capital positions are probably going to be most important.
What can you do about unemployment?
Well, again, it's very difficult for the Federal Reserve for Monetary Policy to impact employment directly, but by making capital and credit available to businesses so that they can expand, which will then enable them to hire more workers. That's one way that it can help. The other thing is by making credit available to consumers to purchase goods that they want to purchase, then that creates additional demand. And so that also helps to stimulate the economy, and with additional demand, then businesses need to produce more, and then they would hire more workers to do that. So that's how the things that we do would impact employment.
You commended the chairman on his exceptional leadership skills throughout the crisis. I was wondering, throughout your emergency meetings, if there was ever a point where you would look around the table and see fear in the eyes of the other people who were there, who obviously...
You could have looked at my eyes.
and kind of how that settled with you, and kind of your experience with that.
You know, it was a frightening time, I have to tell you. There were times when we were dealing with new tools, we were dealing with things that we weren't sure of, and we were able to impact a very small part of the market in order to impact the whole market. And so it was really, it was difficult in that you didn't know how these tools were going to work, you didn't know how quickly they were going to work, and so there were a lot of what we call blue sky sessions, which was, you know, think of everything you can think of that might help, and then we would take the most promising things and look at how feasible they were to implement. I spent a lot of time working with the TALF, the Term Asset-Backed Securities Lending Facility, which was the facility that actually supported loans to consumers and to businesses. And we would look at each asset-backed securities market and look at, you know, what would it take to get funding flowing to that market again. And we were able to do that for a lot of short-term asset classes, auto loans, student loans, credit card lending, that sort of thing, securities backed by those kinds of loans. It was much more difficult in the real estate markets, and we did end up actually facilitating the purchase of some commercial mortgage-backed securities, and that market did finally begin to open up. It wasn't nearly at the levels that it was before the crisis, but still there was money flowing to commercial real estate. We weren't able to do it with residential mortgages. With that market, we were not able to find a way to impact that market, and that market today is still, for the most part, closed. There are a couple of securitizations being done, but not very much.
More or less as a follow-on question, can you comment on the shadow inventory of residential real estate out there?
I assume by shadow inventory you're talking about not only the real estate that's currently on the market, but the real estate that is somewhere in the process of foreclosure, as well as the loans that are seriously past due. And there's somewhere between 4 and 5 million, I would say 4 and 5 million properties that are in that status today. One of the things that's most difficult is that because there's so much foreclosure inventory coming on the market, a large percentage of sales, large percentage of real estate sales now are considered distressed sales. That is, they're sold by the owners of this foreclosed property, and they're impacting prices of real estate in a way that they never have before. So one of the questions that potential buyers and potential investors are looking at is how much inventory is there still to come on the market. The second thing is that the rental rates are actually, vacancies are coming down and rental rates are rising. It's indicating that there's more demand for rental housing. And so one of the things that we looked at in the white paper and discussed in the white paper is taking some of this inventory, rather than selling it out onto the market, actually converting it to rental real estate, either through selling it to investors and financing for investors, or renting it directly, to kind of balance that inventory, that supply and demand inventory. All that being said, the one thing that's kind of interesting is that inventory now, in terms of months of sales of both new homes and existing homes, is coming down in the 6 to 7 month range, which ordinarily would indicate a market that's in balance. Unfortunately, it's at such low levels of sales that I think that would indicate it's still going to be a long time before the inventory backlog is worked through on houses.
Actually, it's interesting you mentioned that, because my question is, I understand for real estate investors having more than 9 or 10 mortgages, there's some rules that kick in and make it more difficult for them to increase their property holdings past that. But to me, that seems a little bit counterintuitive, because it shouldn't be that hard to identify which managers if they can successfully manage maybe 10 rental homes, they can probably do 12 or 15 or whatever. Can you comment on that?
There are restrictions on the number of properties that can be financed through the GSEs, and I can't say that I know all the specifics on it, but it does limit them to the number of properties that they can own and finance through the GSEs. And so, if you want to change that dynamic, that's one of the things that you could change. But still, small investors buying 8, 10 properties at a time can only go so far to work on this problem. There are a number of markets where there are a lot of properties that would be suitable for rental. And the problem with investors in rental real estate is that it's kind of hard to get the right economies of scale in renting small numbers of properties. And so if you think about an apartment building where you have a large number of rental units in one building, it's much easier to manage than scattered site properties, which would be houses that are located all over the place, either all over the country or all over a metropolitan area. So one of the things that we looked at in the white paper was, where were there areas where there were a large number of properties, say 100 properties or more, that were owned by Fannie Mae and Freddie Mac, that could be profitably converted to rental. And so then, if you find where those markets are, then the next question is, how do you facilitate that? How do you provide the financing, or how does the financing come together? How do you bring the GSEs who own the properties together with the investors who might want to buy them? And then where do you find the management expertise to manage that number of properties? And so these are things that again, it's unconventional, not been done before, and so there needs to be a lot of thought going into how that might happen.
According to you, how would a possible collapse of the Eurozone and the European Union influence the US economy? And also, before the outbreak of the European crisis, many people thought that maybe the euro could substitute the dollar as the global currency. Do you think that now, in these conditions, there is another currency that could possibly become a global currency? Thank you.
Question is about the euro and how the collapse of the euro or dissolution of the euro impact the U.S. economy. Well, the U.S. economy is tied to the European economy in many, many ways. Certainly through the trade channel, and problems in the European economy will affect the U.S. economy performance, because we'll export less goods to Europe. The problems that are taking place over there right now are already impacting our financial markets through volatility. Every time there is a different action taken, or even rumors of an action, it moves our financial markets, and so it's made our financial markets more volatile. And an outright collapse of either the euro or very difficult economic situations, very difficult economy in Europe, will translate into a weaker economy for the United States. We are tied to the European economy in all of those ways. So, and then your last question was, is there another currency that might be the global reserve currency? I think the dollar, at least for the foreseeable future, is pretty solidly the global reserve currency.
We recently discussed in class that so many individual consumers would take out loans because they were very optimistic about their future. And it's normal that in recession people wouldn't be optimistic, but do you think that the crisis is going to have a long-term impact on how Americans perceive their future, and is going to change their behavior and their culture? Thank you.
The question is about the American consumer. I think there's no doubt that the American consumer has pulled back quite a bit from spending. A second question is how much of it is due to pessimism about the future, and how much of that is due to simply not having the resources to spend the way that they were before. If you look at measures of consumer sentiment, they are, even though they've improved a bit in the last several months, they're still very low compared to where they had been before the crisis. So there's still a long way to go on consumer sentiment. As far as what the long-term effects of this are going to be, it's really, really hard to tell. We were in a session here. The Virginia Bankers and Virginia Chamber of Commerce put one on, and there was another economist speaking, and he pointed out that the sales of diapers had gone down and sales of diaper rash medication had gone up, which tells you the kind of trade-offs that maybe are being made right now. And so, how long do those trade-offs continue to be made? It's really difficult to tell, although there are signs. There are signs in the hospitality industry. People are starting to travel again. And so it's a question of what individual decisions will people make as they become more confident about where the economy is going and where their own personal prospects are going. And I don't think anybody knows that yet.
I'm in class with the two girls that just asked those questions. And one of the other things that we were talking about was the American culture and how it affected the slow recovery of the housing sector. And what we were wondering was whether or not American pride was preventing people from not giving up their upside-down mortgages, and whether or not you think if they did so, it would help the economy recover faster.
As far as consumer behavior, it's pretty complicated to try to untangle it. I'm not sure that I can do that. As far as the mortgages, there are a large number of people that are continuing to pay even though they owe more on their mortgage balances than their homes are worth. Some of that may be because they expect the homes to be worth more in the future. Some of it may be because they very much want to stay in that home because they like that home. I don't think that the purchase of a home has ever been, for most people, a pure investment economic decision. I think there's a lot more that goes into it, and there's a lot more that goes into the decision to stay in the home, decision to pay the loan, decision not to pay the loan.
Question regarding the asset prices and how that influences Federal Reserve's decision to lower or increase interest rates. We know that tulip mania and the great bull run of 1920s was caused by irrational exuberance, as the term was coined by Chairman Greenspan. And I was wondering if that influences the decision making of what the appropriate level is for interest rates.
Well, there was a time when it was believed that asset bubbles and asset prices maybe didn't have as much to do with what we do. I think everybody, certainly everybody that all of my colleagues, we talk a lot now about asset prices. We're paying more attention to them. I'm still not sure whether monetary policy is the best tool to deal with asset prices or asset bubbles, but we certainly know that we need to pay attention and see what's going on in asset price markets and in financial markets. And so, as I said, we have really a good chunk of our staff now following those markets.
Hi, thanks again for coming. I have two questions. The first one is, would you say that the Federal Reserve is more concerned about inflationary pressure or deflationary pressure right now? And the second one is, with all the concerns surrounding Eurozone debt, there's a flight to quality that takes place and people are buying U.S. Treasuries. And I was wondering what you thought could happen that would push the yield of, say, the U.S. 10-year up.
Wow, that's about 4 questions in one. Let me start with the last one because that's the one I can remember. I may have to ask you to repeat the others. You do have situations other than monetary policy that are impacting the interest rates on Treasury securities. And the big piece is what they call risk on, risk off. And it's whether investors are more willing to take risk or less willing to take risk. And as they become nervous or scared about something that's happened anywhere in the world and want to avoid risk, then they buy up treasuries, which lowers the rates on treasuries. And so as that reverses, that increases the rate on treasuries. So that sort of concern about risk is really influencing what's going on with interest rates in treasuries right now. And I can't remember what the first part of your question was.
I just asked if the Fed was more worried about inflationary pressure or deflationary pressure.
I don't know. I think for me, I'm concerned about both, really. I'm watchful on both. And you have right now, it looks like that inflation is pretty well contained, inflation expectations are pretty well contained, and credit demand is very, very low. So it's hard to see where the inflationary pressure is going to come from, but it's something that you have to watch all the time, and that we do watch all the time.
Back to your white pages idea of converting foreclosed homes into rental units. You had said that the rent has actually been up recently. And is there any worry about maybe if you converted these to rental units that the increased supply of rental units would decrease the demand for actual people buying houses? And, well, why don't I just get a rental unit instead? And 2, if I'm a bank, what's my incentive to become a direct landlord?
Well, first of all, I want to make it clear. I'm not saying that I think we should take all of these properties and turn them into rental units any more than I'm saying that I think they need to all be owner-occupied units. What I'm thinking about are some of the things that are preventing the market from finding its own equilibrium. And so when you think about that, I think there is a demand for rental housing because there are people who, for whatever reason, they can't afford to buy a home. They're concerned about what's going on with home prices for various reasons. They're not in the market to buy. They are in the market to rent. And they're not all in the market to rent multifamily housing. Some of them are in the market. They would like to have a single-family dwelling to rent. And so I just think that we need to make sure that we're not artificially keeping these properties out of the rental market if that's the best place for them. When we did our calculations, there was a calculation of what the cap rate, the implied cap rate on these properties might be, and it was very roughly estimated, but the cap rates on these things were up in excess of 8%, which would indicate a situation where the rental market might be strong enough to have it make sense to put some of the properties in the rental market, but not all of them. I mean, I'm not saying we need to shift from this area to that, but just to make sure that we're looking at all of the possibilities of ways to resolve this large amount of inventory.
So my question is a bit away from policy. I was just going to ask, given the way the media interprets the actions and effects of the Fed and the FOMC meetings, do you think generally the public reacts appropriately or rationally, sort of the way the Fed is intending it to work? Or I guess, in other words, do you think the media skews the way people react to their action?
Most people are very dependent on the media to report what it is the Federal Reserve is doing, and there is a specialized section of the media that focuses on the Federal Reserve and what we're doing all the time, and so I think our job is to communicate through them and to the public as well as we possibly can what we're thinking and how we're thinking about our job and our policy decisions. And so that's why we've talked a lot about communications. And so there are the direct communications that we're making through our website, through all of the different pieces that we talked about earlier, that I talked about, the summary of economic projections, the speeches that are made, and the statements that come out with the committee. If you look back in history, I mean, the communications of the Federal Reserve have just grown and grown over the last 20, 25 years. And I would say that the Federal Reserve is as transparent today as it's ever been. And I think that makes better policy.
Hello, my name is Dan Popescu. I'm a senior here at U of R. It has recently been announced that interest rates are going to continue to be low until at least mid-2013. And obviously the incentive of that is, people will borrow more. But one of the downside that the Fed has been criticized about is that pension funds and general other investors who rely heavily on on bonds, for example, have been hurt a lot due to this low interest rate environment. So I guess my question is, has the Fed considered doing anything about keeping investments into the U.S. as opposed to going for the BRICS or outside investments?
I think when we make our decisions, we have to make our decisions based on what seems to be the best policy for the U.S. economy, and that's what we have to focus on. And when we do that, when you raise or lower interest rates, you're going to affect both borrowers and savers, and in opposite ways. And it's really hard to think about, what are we going to do for this group versus that group? I think what we've got to do is make our decision about what's the best policy for the overall United States economy, because that's our job, and then execute that as best we can. And over time, that's going to be better for all of the U.S. population, and even for other countries. That when we first instituted what they call QE2, there were a lot of other countries that were concerned about what we had done. And even there, I think it's important to other countries that you have a strong U.S. economy. The U.S. economy is the largest consumer in the world. And so there is no economy that isn't helped by a strong U.S. economy. So, that's just the way we've got to do it. And it will have different impacts on different groups.
We're going to go with one last question.
Hi, I just had a quick question. I know the Federal Reserve primarily deals with monetary policy, but I wanted to see what your take on fiscal policy was, because government spending at both the federal and the state level seem to be slowing down the economy per se. So is there anything that you might be able to do at the Federal Reserve, or what your take on that would be?
I've got all I can say grace over with monetary policy. I have no thoughts on fiscal policy.
Actually, that was a short one, so can I just say, what's been your toughest decision on the Fed?
Boy, there have been a lot of tough ones. I guess I have to say that the loan to AIG was probably the toughest one. That was when Lehman had just failed, the money markets were in tatters, markets everywhere were shutting down basically. Everybody was pulling back from the markets, and the question was, are you going to go and lend the money to AIG? And that was not something I'd ever even contemplated before I got there as something that was possible. But when you started thinking about the consequences of not lending to AIG, of having AIG go under, and having one institution after another begin to basically withdraw from the markets, and having credit no longer flowing in our economy, it came down to the point where it seemed that the outcome of not lending to AIG would be worse than the outcome of lending to AIG. But that was a very, very difficult decision.